Welcome to China Events, I am Jason. According to data released by the U.S. Treasury on July 18, at least 19 countries around the world are constantly selling U.S. debt, resulting in a net outflow of $167.6 billion in U.S. Treasuries. This on the one hand will increase the pressure on U.S. domestic liquidity, on the other hand, also means that the issuance of additional U.S. debt will face increasing market challenges. As of now, the size of the U.S. federal government debt has reached $32 trillion, most of these U.S. debt by multinational corporations and investors in various countries around the world to buy, instead of the Federal Reserve in the continuous sale of U.S. Treasury bonds. Data show that in the past year, the Federal Reserve has sold at least $886.6 billion of U.S. bonds, which has become the largest seller of U.S. Treasury bonds. At the same time, Federal Reserve Chairman Jerome Powell said that even if the interest rate hike is suspended, the Fed will continue to reduce its holdings of U.S. Treasuries and MBS. What Powell means is that the bonds issued by our country should be digested by the whole world, rather than the Americans themselves. The rising size of U.S. debt is causing various countries to reassess the solvency of the United States. Meanwhile, the friction between the US and China distracted the US from its ability to sanction other countries. So these emerging countries began to intentionally accelerate the de-dollarization and the establishment of their own currency settlement system. According to Bloomberg News website reported on August 7, an official of the Bank of Thailand said Thailand plans to promote the use of the yuan and other Asian currencies in trade and investment, thus curbing the baht against the US dollar exchange rate appeared to fluctuate sharply. Alisala, an assistant governor at the Bank of Thailand, said in a recent interview in Bangkok that the Thai central bank expects to use the region's currencies more often to help reduce exchange rate risk because they usually keep pace with the baht, the report said. Thailand began promoting the use of currencies other than the US dollar more than a decade ago, a trend that is accelerating as the Bank of Thailand reaches a series of bilateral agreements with many of the region's central banks and improves its financial infrastructure, she said. The still strong dollar has devalued other currencies and become a means of exerting economic influence, according to the report. In this case, many countries are taking steps to mitigate the risks posed by the dollar, and Thailand, which relies on trade and tourism, is one of them. Thailand's central bank has been working with the central banks of China, Malaysia and Indonesia to support their respective currencies, and Alisala said more progress would be seen in this area later this year. The Thai baht is reported to have risen 3% in July this year after a 3-month losing streak, the biggest gain among major Asian currencies. Alisala said, the volatility of the baht against the US dollar has been on the rise since last year, so it is important to increase the means to deal with this situation. China is Thailand's largest trade and investment partner, and the size of Thai-Chinese trade settled in yuan accounted for only 1.2% of Thailand's total trade last year, though it has risen from about 0.3% in 2015, the report said. With China's recent relaxation of regulations, coupled with businesses being more open to exploring alternative options to reduce currency risk, increased use of the yuan is now feasible, Alisala said. The dollar is the most liquid and widely used currency, so reducing its use is not easy, she said. But that doesn't mean we should stop exploring this program. At the very least we should offer alternative options that will mitigate rising exchange rate risk. The Lowy Institute, an Australian think tank, argues that the dollar's status as a reserve currency is under threat and that it is heading into a vicious cycle that will further erode its dominance. That's because the reduced use of the dollar could lead to hyperinflation, which in turn would lead central banks to raise interest rates to fight inflation, and higher interest rates would put pressure on asset prices such as equities, said Michael Roach, a researcher at the Lowy Institute, in a recent op-ed in The Interpreter, a publication of the think tank. The BRICS countries could introduce a currency that competes with the dollar, backed by gold, although such a plan has been controversial, Roach said. Countries such as China, Russia and Saudi Arabia are also starting to move away from the dollar in global trade, which could further erode its dominance. Meanwhile, the US dollar index, which measures the dollar against a basket of other currencies, fell 4% last year, signaling the dollar's declining purchasing power. Interest rates are also at their highest level since 2001 as the Fed continues to deal with high inflation. Roach said, "The trend toward de-dollarization is happening, but it's not unique." He noted that previously dominant currencies have since been replaced, such as the British pound. The world order will inevitably change, and it may well be the era of the BRICS. But some experts have questioned this trend toward de-dollarization, arguing that the phenomenon is based more on fear than reality. Economic data shows that the dollar is still used far more than any other currency, even though its use in global transactions and central bank reserves has declined in recent years. Recently, Argentina repaid $2.7 billion in debt to international monetary organizations. It is worth noting that $1 billion of this was repaid through a loan of US dollars, while the remaining $1.7 billion was repaid through a currency swap agreement using the equivalent value of the Chinese yuan. Although only $1.7 billion, but is the yuan in the international currency payment epoch-making moment. The US relies on the dollar in the currency system in the hegemony of the position, in recent years has been crazy harvesting the world's wealth, and the developing countries such as Argentina's development is good, is the focus of the US harvest. The United States has been using the advantage of the dollar as the international reserve currency and the Federal Reserve's monetary policy in the global economy at all costs for the interests of the United States, which is why many countries around the world have lost interest in U.S. Treasury bonds. Now, more and more countries are beginning to move away from their dependence on the dollar and United States Treasuries, which has developed into a major trending force that will further drive changes in the global currency reserve landscape.